Good morning. This is Emily Costa, and you're listening to the Commodities Institute podcast. It's Thursday, November 20th, 2025, and today we're digging into a compact but consequential batch of market signals that together tell us a lot about where commodity risk and opportunity are converging right now. First, let's start with energy, and one of the biggest headlines of the week. Saudi Aramco has signed preliminary deals in the United States with a notional value north of $30 billion. Those deals span liquefied natural gas, advanced materials manufacturing, and even financial services, and they come at a moment when the kingdom is trying to lock in a deeper industrial and strategic relationship with US partners. The important detail here is not just the headline number, but the direction. Aramco is moving from a pure oil major role into integrated energy, including LNG and downstream manufacturing. For traders, that's a nudge that the Saudis are thinking longer term about demand flexibility. LNG offers a different buyer base and timeline than crude oil. And for markets, it means additional capital flow into US energy infrastructure, with potential effects on regional gas balances and, over time, on export capacity. This is a watch item for US LNG project supply curves and for companies that sit along those chains. There's a vivid example of the global hunt for upstream resources, Namibia's Mopane discovery. Industry sources say majors are in a tight race to buy into Galp's Mopane discovery, which is being reported as a reservoir with at least 10 billion barrels of estimated resources. If that holds, Namibia could become a heavyweight producer in the coming decade. The takeaway for listeners is that frontier basins still matter. Discoveries like Mopane redraw regional opportunity maps, influence shipping patterns, and crucially can change investment priorities for big oil companies deciding where to allocate risk capital. It also reminds us that not all supply-side growth is obvious from current production statistics. The next wave of capacity often comes from relatively unexplored basins. Switching to the Farm Belt, S&P Global now expects US farmers to plant less corn next year and more soybeans, corn down about 4% and soy up about 4% in 2026 versus 2025. That kind of acreage pivot responds to price signals and input economics, and it has knock-on effects for feed markets, ethanol supply, and global grain balances. At the same time, an important trade flow shift is underway. China imported no US soybeans in October, instead sourcing a record high volume from South America, particularly Brazil and Argentina. That dynamic is part geopolitics, part timing of old crop US supplies, and part simple economics. For processors, exporters, and transporters, it matters because cargo flows, freight demand, and storage utilization all change when soybean sourcing shifts hemispheres. For price formation, think of it as a rebalancing that can intensify seasonality and regional basis moves. On the metal side, edits copper price forecasts for next year and the year after to record highs, reflecting constrained supply at the world's largest producer. Production hiccups at mines like Collahuasi and accidents at El Teniente are reducing supply growth just when long-term demand, driven by electrification and infrastructure, remains robust. That's the textbook recipe for structural tightness, constrained supply meeting steady demand. For listeners, the practical implication is that copper market volatility is likely to stay elevated, and companies that hedge or have flexible procurement strategies will be better placed to ride through price spikes. And then there's the rare earth story, a geopolitical and industrial underline that is now moving into operational headaches. The West's push to build a homegrown supply chain for magnets, essential for EV motors, wind turbines, and many defense applications, is colliding with a simple geological fact. Heavy rare earth elements, the likes of dysprosium and terbium, are scarce outside China. Mines and processors in the US, Australia, Canada, Brazil, and elsewhere are scaling up, but the heavy fraction needed to make high-performance magnets at volume remains in short supply. Price spreads reflect that. Dysprosium oxide trades at a multiple of Chinese prices in Rotterdam, and forecasts show the West will still rely on China for the vast bulk of heavy rare earth processing through the next decade. Practically, this means timelines for a secure Western magnet supply chain are long, capital costs are high, and substitution is limited. You can design magnets that use less heavy content, but for high-speed, high-temperature applications, the heavies remain essential. That's a strategic vulnerability for manufacturing strategies tied to electric vehicles and advanced defense hardware. I want to pause here and tie a couple of them. We just talked about new investment from sovereign-backed energy players, frontier oil discoveries, shifts in agricultural plantings and supply chains, copper tightness, and heavy rare earth scarcity. What links these stories is a central theme, a reordering of supply security. Whether it's energy companies diversifying into LNG and processing, miners and processors scrambling to source heavies, or national importers pivoting where they buy their soy, markets are responding to a world where reliability and strategic advantage matter as much as price. There's also a policy angle that feeds through commodities markets. Long-term oil contracts in Asia, for example, are slowing renewable integration even where the economics of wind and solar are attractive. Utilities tied into decades-long purchase agreements are burning coal because breaking those contracts is costly and politically fraught. The consequence is that even as renewable capacity grows on paper, actual utilization can lag, keeping fossil fuel demand structurally higher than a simple capacity switching model might suggest. That has implications for carbon pricing, for the pace of emissions decline, and for metals and fuels demand forecasts. Before we wrap, 2 quick items to flag. Brazil's soy meal exports are on track for a record November, driven by export parity and some US crush shutdowns. That affects feed availability in Europe and Asia and supports soybean complex prices. And in Europe, tensions over gas supply policy are bubbling up. Slovakia is considering legal action against EU plans to phase out Russian gas deliveries by 2028, an example of how geopolitics and legal frameworks can reverberate through energy markets and investor calculations. So what should listeners take away from today's mix of story-new and regionalization of supply chains? Second, treat strategic metals, heavy rare earths and copper foremost among them, as long lead, high-impact risks for manufacturing and energy transitions. Third, watch contract structures and legal frameworks as much as physical inventories. The cost of breaking contracts or navigating regulations can scale up quickly and force structurally different outcomes. Thanks for joining me on the Commodities Institute podcast. If you found this episode valuable, be sure to subscribe, share, and leave a review. I'm Emily Costa. I'll be back tomorrow with more market context, and until then, keep an eye on the supply chain.